Hi, I'm Tom Elliott and welcome to another financial markets update for Hodges Real Estate. Well, good news for property buyers. The Reserve Bank did what many analysts expected and left interest rates on hold at the start of December. So the official rate of interest remains at 2.5%. It also is a period now where the Reserve Bank doesn't do anything until February. So I can guarantee you this, for the next 2 months, barring some sort of calamity which will get the Reserve Bank board members away from their Christmas holidays and back to their desks in January, interest rates will stay on hold until at least early February. The high Australian dollar, however, is causing the Reserve Bank some angst. Now, recently the Australian dollar has fallen from around about 95 US cents down to just 91. However, I have it on good authority that the Reserve Bank would like to see the dollar with at least another 10 cents US wiped off it. That is, the A dollar back in the 80 to 82 cents US mark. Now, to do that, a couple of things would have to happen. It is possible the Reserve Bank might decide to cut interest rates further because that is something that would make the Australian currency less attractive. And let's just remember that the reason we want the dollar lower is so that our exporters, our farmers, what remains of our car industry and so forth can benefit. At the same time, it means that more people will come here and enjoy holidays in Australia, but of course it means for all of us we will not be able to afford to go overseas. There are other things the Reserve Bank can do. For example, it can openly sell Australian dollars in the foreign exchange markets, much, for example, as the Swiss bank does. Or they could do what the Americans are doing, which is print money out of hand to try and devalue it. And that is the other big thing that's happening in foreign exchange markets at the moment. As we speak, and as has been the case for over a year now, the US Federal Reserve, America's Reserve Bank, is still printing 85 billion new US dollars every month, the bulk of which goes straight to the US government. If the Americans stop doing that, the Australian dollar will fall. Unfortunately, there's nothing we can do to try and convince the Americans to do it. Once American unemployment slips below 7%, and currently it's just over 7%, I think we'll see lower money printing from their monetary authorities, and that will also mean a lower Australian dollar, which, as I keep saying, would be good news, even though if you're an overseas holiday maker or an internet shopper, it won't seem like very good news. Share markets around the world hit record highs recently. In America, for example, the S&P 500 did hit an all-time high. Locally, our market is still to recover all of its losses from the global financial crisis, which occurred from 2007 onwards. Having said that, the Australian share market recently hit a 5-year high. And a couple of things that show you that the stock market is healthier. We've got more takeovers. Now, we did have a big bid for Grain Corp. That got knocked back by Joe Hockey, which is complicating for overseas investment in Australia, but still the bid was made. And there is still a hotly contested bid for Warrnambool cheese and butter going on with no fewer than 3 suitors. On top of takeover bids, we've also got a number of floats that are hitting the market. Dick Smith just relisted. Channel 9 is going to relist fairly soon. Freelancer.com listed a couple of months ago. Again, we haven't had floats for quite a while, and the fact that we now do is a sign of the share market's health. Consumer confidence is always close to people's hearts around Christmas time. Now, retail analysts suggest that retail sales in the lead up and the immediate aftermath for this year's Christmas should be around 5% higher than last year's. You might think this would be good for shopkeepers. Unfortunately, the bulk of the increase in sales is definitely going online rather than to your normal shopping centre. For example, I frequently travel up and down Bridge Road, and I've got to tell you the retail mood on that particular shopping strip is not very good. The same is true on Smith Street, Chapel Street and so forth. Having said that, internet sales are doing it very, very strong. Another prediction I'll make about next year, 2014, I think that the federal government will look to make more money out of the GST, which of course it passes on to the states, by lowering the threshold for GST-free internet purchases. At the moment, if you buy goods under $1,000 from overseas, you do not pay the GST. There's been a lot of lobbying around this issue from people like Solomon Lew, Jerry Harvey and others, and I believe that sometime next year the federal government will lower that threshold from $1,000 down to just $50. And it's interesting to note that Amazon.com has now set up an Australian version of its famous book-selling website, and the Australian version, amazon.com.au, does charge the GST, so it's entirely possible to do it. Okay, the property market. Well, there's no doubt in November, property clearance rates and in some areas prices slowed a bit. Now, until recently, the clearance rate had been in the mid-70s, in some markets around Australia over 80, most noticeably in Sydney, but here in Melbourne comfortably around 75, 76, 77%. In the last few weeks, however, this has softened to below 70%. The reason is that a lot more stock has hit the market. Sellers have decided to take advantage of the recent spike in prices. Real estate prices in Melbourne are within a whisker of their all-time highs, and so there has been a lot of stock on the market. For a brief time, I think there's been a buyer's market. People have had plenty of properties to choose from. As a result, excellent properties, and this is always the case, are selling very well, in some cases getting runaway results. However, properties that are B grade, too close to main roads, too noisy, that have some sort of a problem, lack of outdoor space, they are at times struggling at auction. Having said that, once all the current levels of stock are digested by the market, and that will be very soon because we've only got a couple of weeks to go before the real estate industry, like so many other industries, packs up for the summer break. Once that stock is dealt with, I think it'll be back to business as usual, higher prices and higher clearance rates for next year. So when we look at Melbourne more broadly, we've still got massive increases in population. There was talk of Melbourne having over 80 million people now by midway through this century. That's going to create its challenges, but will also be very beneficial for property owners. We have not enough new houses being built. Again, that's a social problem, but good for property investors. And of course, low interest rates. How long will these last? Well, that's anybody's guess. I've noticed in recent weeks that the fixed rate markets, 2, 3, 4 years and so forth, have started to edge up a bit. Loans that were available under 5% are now a little bit over 5%. It doesn't mean that interest rates are about to take off, but my advice, as it has been for the past few months, is lock in some of your debt while you can at these historically low interest rates. They won't last forever. Anyway, that's been another financial markets update for Hodges Real Estate. I'm Tom Elliott. Have a great Christmas, and I'll talk to you again in the new year.